Hello, dividend growth stock investors. It is Colby the DGI Crab, and it is that time of the week again. Every Sunday, I will go over each of the 60 stocks that this channel focuses on to try to see where the value lies. In case you are new, this is a unique dividend growth stock investing channel in that I only am covering 60 stocks. I split them into 4 separate categories or tiers based on the age and time horizon of the investor, which I believe is the most important metric for any dividend growth stock investor to take into consideration. What is your age? What is your realistic timeline to retirement? Do you want to go for high yield, slow growth, low yield, aggressive growth? It all depends on how far away you are from those passive income goals and how many years you're going to need to be able to live off of those dividends. So, only talking about blue chip stocks here, and we have got markets that are recovering here over the 4th of July weekend. I hope everyone's having a nice weekend with family, friends, taking some time off of work perhaps, having some nice grilling, kick back and relax. Happy Independence Day to everyone out there. So let's get right into it, you guys. First of all, I will preface everything by saying I'm not a licensed professional. This should be considered primarily for entertainment, and these opinions are just my own. I'm just sharing my strategy with you. You should do your own due diligence before you invest any of your hard-earned money. And my strategy remains week in and week out as follows. I put half of my money into age-appropriate ETFs every single week for automatic diversification. And when I'm purchasing single stocks, I'm looking for the ones that are yielding 30% or more above their 4-year average yield. I do have a group among the 60 that I consider my top 10 favorite stocks. And for those, I'm looking for more like a 20% discount on those. If that, sometimes I'll just buy them for the sake of buying them. But for the most part, I'm going to stick to stuff that looks like it's yielding really high. I'm going to remain within my particular age tier unless there is a stock in a different tier that is yielding 50% or more above the 4-year average yield. At that point in time, it looks like too good of a deal for me to pass up regardless of what my personal age or time horizon is. And if there's not a viable stock within my tier, I simply will add more to ETFs for that particular week as opposed to investing less. And as we shift into the spreadsheet where I show you each of the 4 tiers, we're going to start here in tier 1 for the 18 to 30-year-old investors, where the goal is to not necessarily focus on high starting yield, but to focus more on aggressive high dividend growth of at least 10% year over year. I've got it sorted, as always, by the valuation tab, where I am comparing that 4-year average dividend yield to the current day dividend yield. United Health remains the most undervalued stock, not only in tier 1, but of all of the 4 tiers. This is the most undervalued stock out of the 60. United Health inexplicably down. Now, you could make some arguments that because there have been some negative headlines in the news over the last few months regarding United Health, that perhaps their stock should be down a little bit. However, down from nearly $600 a share at times to $300 a share, this stock is yielding more than twice the 4-year average yield for several weeks in a row now. I do update that 4-year average yield every single week, so we always have up-to-date information. Last week, this was 1.39. Now it's 1.4. I will continue to just make those slight adjustments. We've got the most up-to-date information on these, but I just cannot look at United Health as anything other than a massive bargain and a total green light for any age tier to invest into United Health. I think you're going to get a tremendous amount of share price appreciation over the course of the long haul. Maybe it doesn't happen this month or even this year. But if you're looking at this with a long-term perspective, especially if you're 30 or younger, this is a great opportunity to load the boat on a blue chip company like United Health while it's trading way, way down. You can keep on hammering that Nike position. It's nice to see Nike up here to $76 a share, currently yielding 2.09%, way up from when it was down in the 50s. If you guys were loading up on it when it was down in the $50 range, good work. Now, the $70 range might end up being more of the normal than the aberration, but let's not forget, just a couple of short years ago, Nike was trading well above $100 a share. I'm still very comfortable continuing to add to my Nike position. I keep adding a little bit every single week, especially as it remains yielding at least 50% or more above the 4 year average yield, which it is still doing. Nordson, this is one of those, you guys, when it was down in like the 180, 190 range, I was so excited to add it. Even recovering up here to the $222 range, it still looks to be a little bit undervalued. 4 year average yield 1.03%, current yield 1.4%. Uh, Continue to hammer on this, guys, because listen, if you were adding this below $200 a share, and now that it's back up to 220, you're not as excited about it. Just to look at Nordson, a little bit of context here on it. I just wanted to show you this real quickly here. If we go to Seeking Alpha and look at the 5 year price history of Nordson, you can see here we're at that 222 right now. But if you're going back into 2024, it was 240, 250 for a good chunk of 2024, sometimes up into the 260 range. Every once in a while, you see it drops down into like the 210s, and then usually up at that 240 range, going back to 2023, has some stagnant months here. But generally speaking, for Nordson, above $230 a share is very normal. Back to 2021, up in the 260s. 2021 right here at about 224. So you can see here, Nordson has been trading pretty flat for the last few years. But then if you zoom out on the 10 year, way up over the course of 10 years. And I think that with Nordson, you just want to grab it when it's in these low periods here. And the dividend growth on Nordson is absolutely fantastic. If we look here at the scorecard, you can see 60 consecutive years of increasing that dividend. Their 5 year dividend growth rate is 15.5%. So you could really get some nice dividend growth and a respectable starting yield here at 1.4%. I'd keep hitting Nordson if I were 30 or younger. Tier 2, age 31 to 41-year-old investors. Only looking at 2 stocks here in this group that are in that buy zone. And this is a group of 19 stocks. So this is the largest group in the 60 stocks that I have picked. Generally here, we're looking at stocks that'll yield anywhere from 2.5 to 3.5%. And we want high single-digit dividend growth year over year. So a little higher starting yield than Tier 1, little slower year-over-year growth than in Tier 1. So it all kind of balances out here. But Target and Hershey remain in the buy zone yet again. And I am still adding to these each and every week. Hershey especially is one that I remain excited about. I do think we're going to get to a point with Hershey where it'll be an overvalued stock for a good long stretch. And if you've been loading up on it like I have been, it is going to really increase the overall value of your portfolio when this one finally does take off. For Hershey, it's just about the price of cocoa. And eventually that is going to level out. But until the cocoa prices are a bit less expensive, Hershey is going to bear the brunt of that as the largest chocolate confectioner on the planet. Tier 3, age 42 to 53-year-old investors, a little bit higher starting yield in this category, 3.5%, 4.5% starting yield range. We still want to get mid-single digit growth in the 4 to 7% category. Got 3 stocks in the buy zone still, being Pepsi, Archer Daniels Midland, and Hormel. ADM and Hormel have both been in this buy zone for quite a long time. Hormel continues to get closer and closer to not being in my buy zone because every single week that 4-year average dividend yield climbs just a little bit. But the financials on Hormel, every time I take a look at it, you guys, it doesn't really look that bad. The payout ratio is creeping a little high up into that 70% range, but they have the money to cover the dividend. They are dividend king with well over 50 years of consecutive dividend increases. I don't think they're going to break that streak. The increases might be a little slow for the next year or two, but Hormel's done some pretty rapid dividend increases over the years too. So I think buying it at a starting yield of 3.8% is still going to give you pretty nice cash flow, and it should continue to increase. Now, Pepsi is still way up here in my personal buy zone because it's in my top 10 favorite dividend stocks. So it doesn't have to be super undervalued for me to want to add to it. And it is very undervalued still. Trading at 4.2% starting yield, 4-year average 2.87%. There are some folks that are a little bit worried about Pepsi right now and how much cash they have available to cover their dividend. The way I see it is Pepsi has been through hard times before. They've not cut that dividend in 50 plus years. So that makes me feel very comfortable to load up on it when it is trading cheap. Tier 4, the 54 and older investors, the high yield stuff remains very popular. People really want to have cash flowing investments in this day and age, and I can't say that I blame them. And the issue that we have here with our current income seekers of 54 and older, where they're wanting to get a starting yield of at least 5% if they're buying individual single stocks, and with a growth rate in the 2 to 4% range, there just hasn't been an opportunity to buy any of this stuff when it looks to be clearly undervalued. So none of this stuff is even coming close to being in my buy zone right now. Half of the stocks are yielding less than their 4-year average yield. So this category of 10 stocks remains pretty overpriced in my estimation. Here's just a quick peek here at my top 10 favorite dividend paying stocks. You could pause here and take a look at them if you want. They're not new. All of them are located somewhere between tiers 1, 2, or 3. But these are the ones that I don't need a major discount if I'm going to buy them. All right, so let's talk strategy here going into the week. Here's the way that I would look at it for myself. Don't take this as advice once again, but depending on my age, going into the week, this is what I'm looking to buy. So half of my money is going into ETFs. If I'm in that 30 or younger category, I'm going to be going 25% each and every week into the S&P 500. I'm going to put 15% towards a small cap value, 5% into VIG for some dividend growth to start building up a position in that ETF, and 5% into the international markets. And the only thing I invest in on the international markets is VYMI, Vanguard's High Dividend Yield ETF, my favorite and only non-US investment. For tier 2, I'm going to go VIG really hard, 25% every week into that, and just pulling back on S&P 500 and small caps, but not entirely stopping. I'm just rearranging my priorities there. Tier 3, I like SCHD, VYM, DHS, all three. I might do a breakdown like this between the three. I might just pick one of them if I want to make things a little bit more simple, but these are the type of ETFs that I'm looking at in that tier 3 category. And then for tier 4, I've got 8 ETFs for tier 4 because there's some other things that I haven't been investing in up to this point that I want to get some exposure to. So I'll go SPYD to keep me covered on the high yield stock front, but then I'm going to get some high yield bonds with SPHY, some preferred shares with PFFA, some MLPs with MLPX, and then Devo, JEPQ, and SPY-I are still my 3 favorite covered call themed ETFs. All have some differing strategies, all pay monthly. Really like all 3 of these. And then for the stocks that I'm going to be looking at for this particular week, so for tier 1, I will prioritize Pepsi just because it is in my top 10 favorites. And then UNH and Nike and Nordson would be my next order of attack. And then I'd probably reach up and grab a little bit of Target in tier 2 just because it is still 50% or more above 4-year average yield. Now for tier 2, I'm going to start with Pepsi, grab Target and Hershey in my own tier, and then reach down into tier 1 to grab UNH and Nike, who have both hit that 50% undervalued threshold. For tier 3, Pepsi, of course, because it's actually just naturally in that age tier, along with ADM and Hormel. And I'll reach down and grab a little Target, some UNH, some Nike. And then for tier 4, I'm going to double down on all of these ETFs. And I'm not going to double down on my international investment, which means I've still got about 5% of my invested capital left over. And with that, I'm going to hit Pepsi there as well in tier 4. So all 4 of those tiers are hitting Pepsi. All right, you guys, let me know in the comments what you are buying, and I will see you next time.